Is now starting. All attendees are in listen-only mode.
Good afternoon. This is Peter Stanton. I'm the publisher of the Worcester Business Journal, and I'd like to welcome everyone to the focus on the Keeping Workers Paid Employment Act, the section of the government's $2 trillion+ economic stimulus bill that has to do with supporting and helping small businesses get through this difficult time. We ran a survey in the Business Journal yesterday asking how critical this funding was, and 72% of the responses said that it was either critical for helping them stay in business or at least would help them survive without major layoffs or restructuring. And I think a lot of the folks, certainly a lot of small businesses are in that same boat. And so we're going to be digging into the details, a lot of the details of that loan program, how it works for different size firms, what you have to do to prepare to apply for the loans, what part of the loans are forgivable and which parts are not, what other costs can be delayed, and so forth. You know, our company has 46 employees, and we've got our application ready for several $100,000, and we're hoping to have that, the majority of that, the vast majority, be forgiven. So I think that's help that almost every small business could use during this turbulent economic times. We are lucky to have 3 panelists with us this afternoon to share their expertise. Those are Amanda Risch, who is a commercial finance attorney at Fletcher, Tilton, PC, Attorneys at Law. Terry Shepard, managing partner at S&G Business Consultants and certified public accountants. And Tom Wolcott, who is a senior VP and commercial banking officer for Country Bank. And so we're going to go in that same order in terms of presenting panelists. And we're going to start with some of Amanda's insights. Amanda, I know you've been taking a sort of a crash course PhD in this new legislation in the last week plus. And so we'd love to hear some of the highlights of what this means for small businesses in Central Mass.
Great. Good afternoon, everyone, and thank you, Peter, for the introduction. Again, my name is Amanda Risch, and I'm an attorney at Fletcher Tilton in our transaction department. Today, I'm going to be discussing the Keeping Workers Paid and Employed Act and the programs that are available under it. So, getting right into it, on March 27th, Congress passed the $2 trillion stimulus bill known as the CARES Act, with the goal of providing emergency assistance to individuals and businesses that have been impacted by COVID-19. One of the most important pieces of this legislation is the Keeping Workers Paid and Employed Act and the Paycheck Protection Program that was created under this act. So the Paycheck Protection Program, or PPP as I like to call it, is one of the most important ways that Congress has sought to inject funding back into our economy. The CARES Act has allocated roughly $350 billion in loans to small businesses and other eligible recipients through this PPP program. But please keep in mind that this is a fluid situation. We have new information coming in regularly from the Treasury instructing lenders on how to implement this program. And Tom will talk a little bit more about that later today. But as of now, PPP loan applications can be submitted starting tomorrow, April 3rd, for small business and sole proprietors, and Friday, April 10th, for independent contractors and other self-employed individuals. Next slide, please. So who is eligible to apply for a PPP loan? Well, it's any business concern, nonprofit organizations, independent contractors, veterans organizations, those that are self-employed. The list is pretty broad. You just need to meet a few criteria in order to apply. So first, you have to have been in business on February 15th, 2020. And generally speaking, you can't have more than a specified number of employees. So for most companies, that's going to be not more than 500 employees. but there are certain circumstances where you may be able to have more employees depending on the industry that you operate in, and I'll go through that in a second. For counting your employees, you do count all your part-time and temporary employees. Those employees are counted as the same as full-time employees when looking at this size threshold. Next slide, please. So when counting your employees, it's important to think about your number of employees together with your affiliate companies. The SBA has certain affiliation rules that look at businesses that are under common control and require those businesses to aggregate their number of employees for the purpose of determining whether the company satisfies the size standards established for these PPP loans. So there are some exclusions, particularly for the food and accommodation sectors, and those are companies that have an industry code beginning with a 72. And for those companies, the 500 employee limit is applied to each physical location. So as an example, and I have it on the slide here, a restaurant business with 1,000 total employees and 10 locations would be eligible for a single PPP loan so long as no more than 500 employees are employed at any one of the 10 locations. There is also an exception to these affiliation rules for franchises so that franchisees and franchisors are not aggregated. Next slide, please. So looking at the creditworthiness of a borrower for a PPP loan. Well, it's important to remember here that the policy objectives for the PPP program are very different than for traditional SBA lending. So traditionally, an SBA applicant would have to worry about demonstrating a certain level of creditworthiness to their lender, which includes demonstrating the ability to repay the loan, typically requires an unlimited personal guarantee, a certain level of collateral, and also that they need to establish that they don't have the ability to obtain credit elsewhere. But with PPP loans, these underwriting standards are significantly relaxed with the goal to get money back on the street, get money to these businesses so that they can continue to employ their workers. So PPP loans will be subject to a couple requirements. One of them I already mentioned, and that's that you have to have been in business on February 15th, 2020. And you also have to have employees to whom the business paid salaries and payroll taxes. The borrower on this application is also required to make several good faith certifications. I won't get into all of them now, but the most important ones are that they're going to have to check a box that this loan is necessary for the business due to the uncertainty caused by the COVID-19 crisis to support their ongoing operations, that the funds will be used to retain workers or to make mortgage, lease, or utility payments, and that you have not and you will not receive another loan for the same purpose for which you're applying for a PPP loan, and that's an important one. Next slide, please. So the question of the hour is, well, how much money can you apply for? The loan that you can borrow is 2.5 times your average payroll costs during the 1-year period before the loan is made, or $10 million, whichever is less. So right now, lenders, and again, this is fluid information, but lenders are expecting that it will take a few weeks to receive a PPP loan, but the Treasury has expressed that ultimately their goal is that a borrower could apply for a PPP loan and the same day that the application is received, that they could receive those funds. So whether this is likely or unlikely, it's unclear at this point, but it's the goal that these loans be handled timely and expeditiously and that money be given to these businesses quickly. Next slide, please. So the key loan terms of the PPP loans are an attractive interest rate to borrowers of 0.5%. Borrowers will also not be subject to any prepayment fees if they have the ability to prepay their loan. Payments of principal and interest will also be deferred for 6 months. That's an important one. And PPP loans will have a maximum term of 2 years from the date on which the borrower applied for the loan. Next slide, please. So how can these loan proceeds be used? Well, the CARES Act includes a really broad list of what the loan proceeds can be used for. And those can include payroll costs, payments of interest on mortgage obligations, rents, utilities, costs related to the continuation of healthcare benefits. And Terry's going to go into further detail in this webinar as to how you calculate these payroll costs for the purpose of applying for a loan under this program. But it's also important to note that it's not acceptable to use these PPP loans to enhance your profits or to refinance long-term debt or to fund expansion opportunities. It's really meant to be used as crisis funds. Next slide, please. Loan forgiveness and repayment. Loan forgiveness is probably the most attractive piece of this loan program, and it makes this loan look more like a grant in some respects. But this section of the Act is very complex. So I'm going to discuss it briefly, and then I'm going to leave it up to Terry to go in more detail about what's included for forgiveness, what's excluded. But first, it's important to note that you need to apply to your lender for loan forgiveness. It's not automatic. Your lender is required to make a decision about forgiveness within the 60 days that you send in your application. And you're eligible for loan forgiveness on the amount that is spent by a borrower on certain specified expenses during the 8-week period after the loan is originated. The loan forgiveness amount can never be more than the initial amount of your PPP loan, and any amount not forgiven will be deferred for that 6 months that I mentioned, but interest will continue to accrue over that time. Next slide, please. So how does a business go about obtaining a PPP loan? Well, time is of the essence. You want to get into this program as early as you can, because when this money is gone, it's gone unless Congress re-ups those funds or initiates another sort of loan program to deal with this set of circumstances. So what you should do is that you should contact your lender that you have a relationship with that would be most interested in helping out their customer in the situation. Try to know your payroll costs and how you document that when you contact them. Know your employee headcount. Those are just some of the things that you can do to start the ball rolling. And if you don't have a commercial lending relationship with a particular bank and you just have a depository relationship with a bank, still start there, see what the banks are saying. Next slide, please. So what other options are available? What if you can't obtain a PPP loan? Well, there are several other SBA loans that are available, but for the purpose of this webinar, I'm just going to focus on economic injury disaster loans, which I call EIDL loans right now. So EIDL loans have always been available even before the CARES Act, but the CARES Act has expanded the breadth of those loans. So these loans have to be applied for directly to the SBA, which is different than the PPP loans. The PPP loans you apply directly to your lender. The group of people that it applies to is similar. So it's the small businesses, nonprofits, certain agricultural enterprises. Those parties are eligible. This loan can be applied for up to $2 million and has an interest rate of 3.75% for small businesses and 2.75% for nonprofits. It has a longer repayment term, so it can go up to a maximum of 30 years versus the 2 years that you have for a PPP loan. But these loans, as of right now, don't have the same forgiveness potential as PPP loans, which to many companies makes them less attractive. Next slide, please. The CARES Act also established an emergency grant for borrowers that have applied for these EIDL loans. So the grant can be up to $10,000 and it can be distributed, we're told, as quickly as 3 days by the SBA. We're a little bit suspect of that, just the time frame that the SBA normally operates is traditionally a little bit slower. But what's attractive here is that if your application is denied for an EIDL loan, the emergency grant does not have to be refunded. And these emergency funds are supposed to be used for the same sorts of purposes that we've been discussing here today. But an important question is whether you can get a PPP loan and EIDL loan at the same time. And the answer is that you can't get these loans for the same purpose. So that's all the government has put forth right now. The loans are not available for the same purpose. And then I think at this point, this pretty much covers these basic SBA programs, and I'll turn it over to Terry to talk more about the nuances here.
Thanks, Amanda. So the loan application update, I'm going to leave that obviously to Tom, except for the same message that Amanda used, that if you haven't put an application in now, as soon as you hang up from this webcam, you should be calling your bank, get the application in, and get them the supporting documents as soon as you can, because this money will run out rather quickly, I believe. Now you're going to calculate the amount of the eligible loan. You got to take a look at your total payroll costs for the preceding 12 months, and then you're going to multiply it by 2.5, and the maximum is $10 million, as you can see. Next slide, please. So the payroll costs, when you're making that calculation of the total payroll, you can see 1 through 4 there. It all has to do with salaries. And then you also add in your health insurance costs and your retirement benefits, and then the state income taxes on that. And so that's the total amount that you're going to be multiplying it by 2.5 times. Next slide. Now, excluded from the payroll costs is any compensation that's in excess of $100,000. So when you're doing your application, you need to not just give them the 940-41s, so supporting the payroll amounts, but you need to have a calculation of putting in a maximum of $100,000 on a separate schedule for the employees that are over. Anybody that you're employing that lives outside of the U.S. on a permanent basis is not eligible, so those wages are excluded. And then if you are eligible for any credit because of the Family Response Act, then you can't duplicate it. So those wages are not part of that computation either. Next slide. And this is the real carrot. Again, as Amanda had talked about. I mean, the whole purpose of this CARES package was to make sure that we retained, us employers retain employees, and if we laid anybody off as a result of the decrease or we can't open the doors because we're non-essential, they want them to be rehired so they have money in their pocket to be able to survive until things turn around. And to me, it's great having a loan and having 8 weeks worth of working capital to make the payroll and a few of the other expenses that I'll list of what's eligible. And if you're spending all of that, what you receive for those purposes, then the loan would be forgiven except for a few exclusions. So next slide, please. So it's going to be decreased by the computation of, you look at your full-time equivalents from February 15th to, should be June 30th of 2020. And you're going to divide it by the prior years for that time period. And obviously, if you have more employees in the current year, 2020, then it's going to be over 100%. And that's why they put in there, you can't increase the loan forgiveness by working this formula, which Amanda also had mentioned. And besides that limitation, then if you kept your employees on, but you reduced their salary by 25%, then those wages also are not eligible for the loan forgiveness. Next slide. but there is an exception for those. So as I said, they want you to retain, and they would like you to rehire anybody that you might have laid off. So if you rehire the people before June 30th and increase the wages back, if you load them more than 25%, then these exclusions or these reductions of the loan forgiveness is not included, and that just has to be done by June 30th. And then obviously the best part is whatever that amount is, it's not going to be included in income. You don't get too many of these opportunities like that, and that's because the government really wants you to retain the people and hopefully keep your doors open, that you survive. Next slide, please. So some of the other care provisions. There's one of the parts of it, the SBA loans that Amanda had talked about for new loans. The government's going to pay for the first 6 months, and that's going to be the first payment after you get the loan. And then for existing SBA loans, either from the 7A program or the small business investments, then the next payment due after the date of enactment, then the government or the SBA is going to be paying for those also. So they're really trying to, when you're looking at crisis management, the first thing that you're advised to do is stabilize the business. Well, most businesses can't do that right now because it's out of our hands. And the second one is cash. And so they made a good few provisions in here to allow the business owners to get some additional cash into their pocket. Next slide, please. So here's the other side of the cash is king. So there's also a potential of a employee retention credit. And so you have to make sure that you're operational in 2020 and that your sales, either your business was suspended or because of the government actions, partially or fully, and or if there was a significant decline in your gross receipts from one quarter to the prior year quarter of over 50%, then you would be eligible for this credit. Now the credit is going to be taken right against your payroll taxes that you would normally have to deposit, and when you're filing your quarterly return, so it's immediate cash savings for those who are eligible. Next slide, please. So the credit is equal to 50% of the qualified wages. So the maximum, though, for the rest of this year is only $10,000. So the maximum credit you can get is $5,000. And so that's for many wages, as you can see, from March 12th to the end of the year. Except for those employers who are eligible just because of the gross receipts reduction. Once their gross receipts for a particular quarter are up to 80% and over compared to the prior year, then their period ends right then. Next slide, please. So anybody that's going to be taking this PPP loan, the PPP loan, is not eligible for this credit. And the wages that are eligible, there's a definition for it. Companies that have less than 100 people, it's all the wages that are paid. And if there's for those who have over 100 people, it's only the wages that are paid during the times that you're partially or fully business operations is suspended by the government orders, and you're paying the employee and he is not working during that time period. Next slide, please. The second one that they have is the delay of the payment of payroll taxes. So it's from the period of enactment to through the end of the year. And so 50% of the deferment is payable the following year. So you have a year plus on the payroll taxes that you would normally have to pay. And then the other 50% is due in 2 years' time. So as I said, they really are trying to free up some additional cash as many ways as they can. And again, an exclusion, anybody that has any loan forgiveness, which is what we're talking about, hopefully that people that qualify for the PPP loan, they're not eligible for this credit. Next slide, please. So the net operating losses in the TCJAX, the Tax Cuts and Jobs Act enacted, they reduced the amount of limit of the NOL that you could take in a particular year, and it was 80%. And they also eliminated the carryback provisions. They said it's no more carrybacks, but now you can carry forward indefinitely. Well, this is now suspended, both of those rules, so there are no limitations. And you can now go back and amend your 18 return. If you filed your 19, amend that return, or at least if you're going to file it. If you have any NOLs, and even in 2020, carry them back 5 years. And so it's obviously recommended that if you're in that situation, you should immediately be filing amended returns to free up some of that cash that might be available. Next slide, please. Now, the individuals were also affected by the NOLs, by the same act. Married couples, limitation of 500,000 of losses to carry back or carry forward in the against any year. And if you're an individual, 250. Those are also retroactively suspended. So again, it makes sense to amend those prior returns to get back some free cash. Next slide. AMT credits are now refundable, and I don't know what they're going to be, but the act provides for an expedited refund procedure. So I haven't seen anything. I don't know if Amanda has or not, but I think some of these things are just going to be coming out slowly of the procedures as they work through the programs. And then there was a limitation on the amount of interest that businesses that had revenues over 25 million could take. It was only limited to 30%, and now it's increased to 50%. And and they've also allowed, so there's an increased deduction based on what the law would have been, again, to make sure that people aren't paying more taxes than they need to, because they need that, obviously, the cash from their pocket to operate. And then the added bonus on this is 2020, the taxpayers could elect 2019's taxable income in place of the 2020's, because that will maximize the deduction also. Next slide. And for individuals, they've allowed some excess cash that you can take out, which is a dangerous thing. We've already lost the value of 25% or wherever it's going now, and taking money out of here, it's going to be tough to put it back. And but you can take up to $100,000 in coronavirus-related distributions and not be subject to that 10% penalty. You will have to pay it back, but they're going to give you 3 years to repay it, and without any regard to the annual cap limitations they usually have in here. And then if it's not paid back, then you can spread the income over a 3-year time period. And obviously they increased that loan account that used to be borrowing maximum was 50,000. Now it's 100,000. They also added, if you had any loans pre 401k or retirement loans before the date of enactment, those payments will be deferred also to the end of the year. And then the minimum distributions for certain plans for people that are 70 and a half, they've been waived for this year. So Peter, you going to take it over, or Tom, you want to?
Yes, I'm gonna. I've got the baton and I'm handing it straight over to the left, so Tom can give us the banker's perspective. It sounds like we've teed you up.
You teed me up well, yeah. So both Amanda and Terry went over the program in great detail. I'll give you a little overview in terms of how a bank is trying to process these with a little background first. The details came out this week, literally. Friday it was signed. We were looking for details Monday, Tuesday night, some clarity came in terms of the terms that we would be able to offer. And we are still looking for some clarity from the SBA in terms of documentation and other key pieces. We're going to continue as an institution to process the applications, but just again, we still have a fair amount of unknowns. But it's important for our customers that we get them in the queue, because there is a time stamp. There's a limitation to these funds. So what I would encourage anyone who is looking at a PPP loan, that's specifically what I'm addressing today, reach out to your institution, and it's critical that you reach out to the institution you deal with, even if you don't have a loan, if you've got a deposit relationship. And the reason being, there's two key things that a bank needs to certify. Number one is that they know you. There's a called KYC process that takes a few days. Someone coming in, there's some, and it's complicated now with a COVID virus. It could take some time to confirm that we've certified your identification. And the second is we have to certify as an institution that you are in business as of February 15th. If we don't, the SBA could come back and not honor their guarantee. And so there's real risk to the bank if we don't follow those processes. So that's why it's important that you go to the institution that you're dealing with. If you have not heard from your institution, I would urge you to go to either the SBA's website and get an application, or the treasury.com. They also go onto their website and they have an application, and I would start filling it out. The information you need is tied to your payroll, as Amanda went through. There are some exclusions, but it's fairly straightforward, and the math is again fairly straightforward. And I would at least get the application and the background information ready to go, and then be persistent to reach out to your institution. The process, so there's a front end, and we're working through this now. Tomorrow morning, we're going to start processing the applications that we've received for our clients, and we're going to enter them into we're going to review them. There's certain key, we have to make sure that the math works, frankly, and the SBA is leaning on us. If the math is wrong, again, that's another way they could not honor the guarantee should things go sideways. Then we can document it into the SBA's portal, and then we will wait for them to come back to us, confirming the guarantee is in place, and then we'll reach out to our customers and let them know. The second step, of course, is after we've gotten that out of the way and the allocations have been sent, we need to document this. And unfortunately, that's where we're still waiting. We had our attorneys have had conversations within an hour of this call, and there's still not clarity on whether we need to use standard documentation. But again, the key is to get you into the portal and get the decision. And as you've also heard, for the forgiveness piece, there's a third sort of milestone, and 60 to 90 days from now, towards the end of the window, customers will come in and they'll apply for a forgiveness piece, and the bank's required to confirm the calculation is correct and process that with the SBA. So that is the bank's role right now. And again, I would urge you to reach out to your institution. Every institution is eligible to, under this program, they do have to reach out to the SBA if they're not an SBA preferred lender, but they are eligible, and they do need to, and they can, through an abbreviated process, access the portal, which is the key to getting the application in. I imagine there's a lot of questions, but I thought I'd give you an overview of the process and a little bit of the bank's perspective.
Terrific, Tom. Thank you very much. So that was a fire hose of information from all of you. When folks registered, we got a number of questions that got sent in beforehand. And while we've been on with over 500 people, we've had a lot of questions also submitted. I think the number one question coming in right now, while we're speaking, is that detail, and anyone can take this, the detail of when I'm filling out my forms for the bank. Am I giving you my payroll numbers from calendar or fiscal 2019, or do I need to do March through March 2020, which literally just ended, 2 days ago? Which is the correct submission?
I can jump in. Again, this is where the SBA has not been clear. So it could change, but we're going with the calendar at this point because we're also going to ask for the 941 document, which shows the payroll taxes, so we can validate and tie the two together. And again, we don't have perfect clarity from the SBA, so it's possible we may come back and ask for the 12-month period, but that's a decision, again, we had to make on the fly in the absence of information. Does that help?
If I can, Peter?
Yeah.
So I've been having our clients and give them both. Give them the calendar year 941s and then the payroll that they have, the records they have for the first quarter. So they would have it already. And then obviously we have to follow up with the actual form for if they're going to verify the for the payroll taxes versus the payroll records. So that way the bank has both right off the bat.
Okay. Next question. If an employee rather resigns prior to or during this 8-week period, how will that affect the eligibility for the grant? For instance, if someone has one person quit and they have 10 employees.
Peter, I'll try to take this one. So my understanding is that this cure period where you could rehire your employee that you might have laid off or furloughed by June 30th is not employee specific. So if someone resigns or you lay somebody off, but you rehire that position, you could still be eligible for this cure in terms of reducing your forgiveness eligibility.
Okay.
And otherwise, Peter, otherwise would be a it would be lower for the, so when you're comparing the FTEs, the full-time equivalents from time period to time period, it's going to be lower, and so it's going to lower the amount of the loan forgiveness, as far if that's where the question is. I mean, the purpose of the act was for people to rehire anybody that they might have laid off from February 15th on.
But if that's a different person filling the same full TEs, it still counts towards that credit.
That's correct. Yep.
Yeah. So next question. Applicability to 1099 contractors not on a W-2 but are self-employed. And how's it apply to them? Who wants to take that one?
Applies the same way. It's the net earnings that they have, the net income that would be subject to some of the computations. They certainly, a lot of the self-employeds have some specific details that would need to be looked at, but it's basically the same laws, and they don't have a payroll per se, but their income is their pay, so it's subject to some of those same provisions.
I believe it would be subject to the 100,000 capped, wouldn't it, Terry?
Yes, it would be. Yeah.
So here's an interesting one. I have laid off my staff. Can I still apply for a loan to cover rent? And maybe on top of that, if that person hired them back, or some of them, what period do they have to take that action in?
Up to, they can hire the people back up through June 30th. It's because you're going to be comparing the full-time equivalents at that time period, right? I don't know if there's any other provisions that come out, but
they're going to get very little of that loan, correct? Because it's based on employment. So you have to get the loan, you have to hire your folks back.
Well, no, they'll get the loan. It's just that the forgiveness part of it won't be there.
Okay.
And that's why they, the Senate had a up to the law was written, an up to 10-year amortization payback for any amount that wasn't part of the forgiveness allowance, and they changed that to 2. And I'm assuming is that they want to make sure that people are going to spend it according to what they wanted, and having to pay it back in 2 years, people better be very careful of what they spend it on and do the right thing.
Mm-hmm. Okay. Question, if a company is classified as an essential business, is working normal hours, and employees are 6 feet apart during normal operations, what if an employee chooses not to work because they're uncomfortable? What is their status, and how does that affect this loan program?
Go ahead, Mr. Attorney.
Well, I don't purport to be an employment attorney by any means, and this is a little sticky, but my understanding is that if it's an essential business and the employee needs these employees to be there and be available, that they would be expected to go to work. But that being said, if a person felt uncomfortable, that they could communicate with their particular employer, and employers in many cases would be willing to allow that employee to take sick time or paid vacation, or whatever the particular company offers.
Okay, here's another one. If someone owns more than one business, can each business apply?
Under the aggregation rules, and as a matter of fact, is a question on the application. Are there related businesses, and you have to put a schedule in. And to me, and I've been telling the clients to them, and also put in the number of employees in that other business. I believe that's for the aggregation rules that you have to be under 500 employees.
Okay. And here's a question. I think this is aimed at Amanda. Could you clarify that self-employment and sole proprietorship are the same? Both would file Schedule C. Is that correct?
Yes, but I would say that right now, if you are self-employed, you would have to wait until next Friday to have your application submitted for a PPP loan, versus sole proprietors can submit as early as tomorrow.
Okay. If we don't need to lay off staff now, but we might. How will our unemployment expenses be impacted? Also, would that extra $600 supplement from the federal government on top of the state's unemployment also affect our unemployment payments down the road? That's a tough one.
Yeah, I suspect that it won't, because it's from the federal government that's funding it and not the state monies that's put aside. The extra $600, I was just talking to a business owner today, and he had manufacturers that, employees that he laid off, about 7 or 8 of them, and they're collecting unemployment and they're making full pay. And so the people are saying, well, if they're making the same money, I don't want to work anymore. And so he actually had to give everybody a little bit of a raise just to stay for, combat pay. So I think it was very generous of the monies, and that was the intent, getting money into people's hands to spend it and to live.
Mm-hmm. So here's one from a seasonal employee. The application asks for average payroll from July to March last year. We have summer seasonal employees who work at a summer camp who might not be hired for this summer. Should we back out the seasonal pay from our payroll figures for that 10-month period?
Well, I know they have a separate. I don't know if Tom or Amanda has anything specific. I know that there's a separate computation for seasonals and how they compute their FTEs, and so I would have to go through and get the specifics of how they compute it, because there is something spelled out very specifically for seasonal businesses.
Yeah, I think they allow you to look at the period between February and June. I'm not sure that would help the camp program, but there is an attempt to have seasonality component. Then you use your average payroll for that period.
Okay, some of these are tough ones. So benefits are eligible expenses, meaning healthcare along with payroll is covered. And it looks like healthcare costs can be calculated into the loan to be forgiven, but we also do a 401k match. Is the employer 401k match an eligible expense under these loans, grants, or these loans?
Yes. Yeah. Yeah, Peter, yes.
Okay, that was a good answer. Here's another question. Can you talk more about the certification that current economic uncertainty makes this loan request necessary to support the ongoing operations of the applicant? Is there any guidance about how to make that determination?
So Peter, I'll take this one, and Tom, you can probably weigh in here. But my understanding is right now there is no guidance for lenders at this point on how they determine whether the loan was necessary for a business. I believe that everybody's waiting with the, anxiously waiting for more guidance on this piece of it. But I think you just kind of have to look at this point at whether it passes the straight face test and go from there.
Okay.
I would agree. I think it's a reasonableness test, but I think it's fair to say, there's no aspect of the economy right now that's not being impacted.
So Tom, here's one that we actually talked about this morning, and it's a question that says, if my bank is not an SBA lender, should I cold call, it says, other banks to try and get a referral? What should someone do?
Yeah, that's a great question. And we are getting quite a bit of interest from non-clients, and it's hard because, again, we need to focus on our clients. We want to help as many people as we can, but we're kind of every bank that doesn't have a relationship is sort of handcuffed because there's certain certifications we need to make in real time, instantly, to process the application in a timely fashion, and they just can't be made instantaneously. I mean, and I would lean on your existing institution. Again, no matter what size they are able to reach out to the SBA and apply in a very abbreviated fashion for access to the program. I know the SBA is busy. It's hard to get a hold of them now, but that is the unfortunate reality. I think all the institutions, we all want to do the right thing. And if capacity allows, we certainly will help anyone we can. But our priority has to be based on, and I think I'm speaking for most, if not all. I hate to speak for the industry, but I think I'm speaking for most, if not all, of my colleagues throughout the other institutions.
Got it. Here's a couple more, and we're actually, as folks may notice, we're actually going overtime. We'd said 3:45, but because there are several questions, and I'm trying to get to the questions that are the most common, we're not going to get to every single one of them, but we do have another seminar coming up on Monday at 2 o'clock. And I think that maybe in that one, we'll do more time for Q&A, but let me get to a few more. For nonprofits, when you're signing that form, the bank application form, it's got a line for owner. Should that be certified? Should that be an executive director? Should it be the chairman of the board? And how do you switch those titles around based on how it looks now? Answer that one later.
Go ahead, Tom.
Yeah, I was going to say, I think the SBA may be looking at, that might be one of the other things that the SBA has on their list. I think there's some ambiguity on that, but I would accept an application with someone who has authority signing there. As long as someone has authority to sign, I would accept the application, given the guidance we have now.
So executive director or board chair might be sort of the first two people on that list if we used common sense.
Amanda, what do you think on that?
Yeah, I would agree, especially where these applications are being submitted through a lender who knows you. You generally know, even with a nonprofit, who has decision-making ability with that particular company. So,
yeah, we are in a community where not everybody knows everyone, but pretty close. Question: are wholly owned subsidiaries of a foreign company eligible?
That's a really good question.
The employees are U.S. citizens.
That's a good question. I would think that they would be, but I'd need to look at the legislation a little bit more carefully, and I can certainly get back to whoever asked that question if you want to give out my email.
So we're going to put some contact information at the end of this and send it out to all the folks who are on the webinar. And we're going to, I believe, have access to everyone's set of slides. And Tom, you had included the loan application and some other helpful documents that are also going to be all attached to everyone who signed up for the webinar. And we'll have that feedback. So we'll be able to pass on those questions, and we can maybe get to some of them before next Monday when we are on the air again. Let me just squeeze in one or two more if we can. We talked about the cost of healthcare being included in addition to payroll as a forgivable element, and Terry also confirmed that the 401k portion was also forgivable. Are there any other benefits that would be included in that sort of forgivable space?
Benefits being expenses?
Employee benefits. Yeah.
No, I don't believe so.
Okay. And again, a lot of folks, this question comes up in 7 different flavors. If we've laid off employees, do we need to rehire and pay them in order to receive the loan forgiveness?
By the formula that you're going to go under, yes, they're going to be comparing to their prior, the prior year's FTE, and they're also going to be looking at if you laid somebody off, did you rehire them? That's going to have to be, I'm sure, one of the tests that when you're asking for forgiveness that the bank has to verify that they had lost somebody, but they added somebody back on that to replace them. I mean, they have to come up with numbers to pass for the loan forgiveness.
If someone had 20 employees and they laid off 10 and they still have 10 and they applied for the full loan amount, simple math would suggest that close to 50% of that loan amount might be forgivable because they only had half the employees during that period. Is that an approximation?
Sure.
Approximately
Yes.
Correct?
Yeah.
Okay. Let's see. We are at 3:52. We've covered a lot of ground, and I think we'll send out some contact info as well as some of the slides from today. I hope this has been really helpful. It's been great listening, and I want to thank all of our panelists for loaning their expertise to all of us this afternoon, and also like to thank our sponsors who are from the same companies, Fletcher, Tilton, PC Attorneys at Law, and of course our presenting attorney, Amanda Risch, S&G Business Consultants and Certified Public Accountants and founding partner Terry Shepard on the right, and also want to thank Country Bank along with Tom Wolcott, our presenter today, who is a Senior VP of Commercial Banking. And let's also thank behind the scenes running the show has been Alan Falcon, who is with Cumulus Global and is another partner, sort of event supporter. And we'd like to thank Alan also for making this, avoiding technical glitches and helping this go along seamlessly. So thank you all for being part of this webcast. We have another webcast coming up on Monday at 2. If you want to re-sign up for that and send questions, we'll probably spend more of that time on the Q&A side. That's Monday, April 6th at 2. And thank you all again for being part of this webcast.
Thank you.
Thank you.
Thank you.